And the first thing I'm sure you guys are all aware of is the definition that goes in front of crypto, which are these digital payment tokens. So this is kind of the definition that starts the layer of cryptocurrencies. So they are defined as cryptographically secured digital representations of value that function as a medium of exchange. And so this is basically just the definition of all crypto assets, your Bitcoin, your Ethereum, your Litecoin. And these are some of the characteristics that they possess. So they are not pegged to any currency. Off the bat, there's some nuance there with stablecoins, which we will discuss. Fungible, so they are interchangeable. So this does not include NFTs. We won't really be going NFTs too much. But if you heard about that, this relates just basically to cryptocurrencies. And they're accepted as payment by the public. So there's medium of exchange. And on top of this, under the Payment Service Acts 2019, Singapore has a DPT license, a digital payment token license. And what can be done with this license is buy and sell DPTs, operate and exchange, custody and safeguard these assets, transfer and transmission, stablecoin intermediation, and also stablecoin issuance through a major payment institution license. And so one might be thinking, okay, that's cool. This is an interesting license. Why does crypto and this matter to me now? Well, the reason this sort of thing matters is currently today, Singapore has over 30 plus licensed digital payment token providers that are licensed under MAS. These are institutions that are able to deal in digital payment tokens, operate digital payment token exchanges, and provide custodial services, do all the things we mentioned. And they can provide those services not only as themselves, but to clients, meaning that your clients at some point may hold these or may have these. And so the other aspect I want to get through here, and I will get through during this presentation, is that basically Singapore is already building this infrastructure in order to use these digital payments. Singapore has this live initiative called MAS Project Guardian, which has over 40 live examples and 40 live tests of tokenization and stablecoin use specifically. And so I'm going to go over 3 examples here. We won't go over them too in depth, but it's kind of just for you to get the lay of the land. So some of the experiments that MAS has been working in with tokenization is cross-border repo payments or repurchase agreements with UBS, DBS, SBI. Also tokenized secured notes that DBS has started that actually have real volume behind them, such as over 1 billion in the first half of 2025, growing at a 60% quarter over quarter, and they offer instant settlement, and we'll get into what instant settlement means. But another example of institutions trying to use this technology to provide efficiencies in the marketplace. And then MAS themselves have been looking at tokenizing MAS bills in order to settle payments faster and be able to have a digital Singapore exchange in a single transaction. And on top of this, there is reporting within Singapore that is coming soon. So there is CARF, the Crypto Asset Reporting Framework, and CRS 2.0, which is an updated common reporting standard. And what these are specifically on CARF is it's tax authorities that are basically transacting more on crypto transactions. They want more granular reporting on crypto transactions, and the scope is more cryptocurrencies, stablecoins, and tokenized assets. CRS 2.0, I'm sure you guys are all aware of this, is just expanding further reporting with e-monies and CBDCs, which also have crypto exposure to them. And so the timeline for these are pretty recent. So data collection starts for CRS 2.0 and CARF in January 1st, 2027, which is not that far away. We're already halfway through the year, and this is on the horizon. Also, this says May 31st, 2028, but basically the first reports under CARF are in line to come out in 2028, and this is just a general reporting timeline. And then CARF itself is kind of this global initiative that Singapore is a part of to figure out how to do crypto asset reporting in a more granular level. And so the first exchange of information with how that goes will be later in 2028. And so I bring up these 2 pieces of regulations, and the question might be why and what is the point of this? Well, essentially what we have today is we have this blockchain ecosystem that has been doing a bunch of on-chain transactions and has shown some real utility with transparency, on-chain settlement, and auditability. But we also have this traditional finance and investment role that has been around for a while and has these different regulations and has rules in place and different setups about how to carry out business, which this blockchain ecosystem doesn't have. So at this moment, these two are separate, but CARF and CRS are really a way to patch these two together in order to have the benefit of some crypto assets and crypto vehicles while also maintaining regulatory certainty, and also security of customer funds. And so the question I want to pose with you today is not if you believe that Bitcoin is going to be the best thing, or if Ethereum and these crypto assets are going to be the next wave of digital finance, but it's basically that, do you think and will your clients be using digital assets? Because if they do, that is extra reporting and extra standards that will have to take in place. And I wanted to give an illustrated example about why businesses would benefit from things like stablecoins and tokenization specifically, and kind of what the pitch is to these businesses for using these things. And so I wanted to start this illustrative example with a mid-sized commodity trading firm that imports raw materials and resells them to buyers. Just for a fun fact, Singapore has over 400 of these specific companies, and they do exactly this. They buy supplies from outside countries and then sell them to outside buyers, and they earn a margin on the spread. And so a traditional payment rail system like this would basically have a local bank that would take a fee on the payment, this FX conversion, which is a 1.5% conversion rate that is beneficial towards banks, and then a correspondent bank that would also take a fee. And then after all of this, the supplier or whoever is receiving the funds would have to wait 3 to 5 business days in order to get this money, in order to transact, and in order to use these things. Sorry, there was a question. Yes, these will be shared after, most definitely. Going back to it, and so in a stablecoin setup, you can see that these intermediaries can stripped, right? All 3 intermediaries are down into one transfer with a chain, and these network fees, or these correspondent bank fees, consolidate just into a $1 network fee. And then you only have to deal with on-ramp and off-ramp and different FX rates too. But the end goal and total cost in is around 1/3 of the normal cost that it would take for traditional savings. And so you can see on a company like this that does, say, $80 million of volume with cross-border payments, they can have a real savings of 828,000 Singapore dollars to their bottom line, which is a material amount that can actually help the business become more profitable. And so that is the savings pitch for using tokenization and digital assets across networks. But the other pitch, which we will see and get into, is really the settlement time. So all these correspondent banks together, it's annoying, the fees are annoying, sure. But the real thing that is a pain is having to wait these 3 to 5 business days when you have operations and when you have payments to make. And with blockchain, the settlement time reduces not only to days, but in hours, and in some instances, seconds. And that is when suppliers and business owners can get their money instantly versus having to wait. And so these savings improvements they sound good theoretically, but are people actually doing this? The answer is yes. JP Morgan has a platform called Onyx that does tokenized repo lending. They have done 1.5 trillion to date, about 2 billion of daily volume, and they have reported and have verified $20 million a year in savings versus a traditional overnight unsecured credit line. EY does this survey with Coinbase, which we will get familiar with because we will dive into the 2026 survey, where they ask institutional firms about stablecoins and also tokenization. The group of these firms is about 350 firms, and of the 41% of corporations that use stablecoins, they report 10+% cost savings versus traditional methods, with the #1 example being cross-border payments, as we illustrated in our example. And then there are also government institutions that are also using this technology. For example, the European Investment Bank has been using tokenized digital bonds since 2021 and have issued over 400 million euros across the years. And their main improvement is this reduction in settlement time. Their settlement has reduced from 2 business days to same day. And this is what is known as T+0 bond settlement, which is the real benefit to these corporations and to these government level entities. And so we're going to start going into the actual content of this tokenization. What is stablecoins? How does digital assets work within the ecosystem? And I hope to deliver value on that. But in case I am unable to do that, or that the time lag draws, I want this single takeaway for you to have, is that digital assets are already creating professional obligations in Singapore. This isn't about whether you believe in crypto, whether you believe in Bitcoin, Ethereum, or what have you. It's about whether your clients hold digital assets, accept digital assets, and need to report it. And more likely than not, if they hold or accept some form of digital asset, being tokenized funds or stablecoins, they will need to report it, and we will discuss how they do that.